With several high-profile IPOs in 2020, from Airbnb, Snowflake to Robinhood, and with Forbes calling SPACs the hottest trend of the year, in this video I'll explain why I'm cautiously staying away from these investments and how to capitalize on this opportunity with less risk. Hi, my name is Kobe, an associate with Noor Private Wealth. If you're new to my channel, we focus on helping individuals build wealth in the most tax-efficient way. So if that's something that you have interest in, make sure to subscribe so you don't miss out on anything important. And as always, if you like this video and you find it helpful, make sure to hit the like button. It really helps with the YouTube algorithm. So let's jump right in. Let's start with SPACs, which stands for Special Purpose Acquisition Companies. These are specialized kind of IPOs or initial public offerings, and they are referred to as blank checks companies, as they raise money from investors without providing a detailed business plan. They are typically promoted as supercharged IPOs that starts out with a surefire opportunity chosen by an expert. Sponsors of SPACs usually include well-known venture capital investors who have had at least a few big wins. The SPAC goes through an IPO-like process, raising money and getting listed on an exchange. Its next goal is to find another business to buy, usually within 2 years. Then the two companies merge, giving the purchased company a relatively quick stock exchange listing and the liquidity that comes with it. For doing that, the SPAC sponsor or manager gets up to 20% ownership of the merged company at a low or no cost price. If the SPAC fails to find an acceptable takeover candidate within the allotted time frame, often 2 years, it folds and returns any funds remaining after expenses to the investors. This obviously gives the SPAC manager a great incentive to buy something as opposed to folding the SPAC and returning the cash. Now, historically, SPACs are found to have lost about 3% a year compared to market according to research. This is historical data, of course, and more recent SPACs could have potentially done better. Research also found the SPAC managers do incredibly well from the transactions, given they typically receive shares at discount prices while investors may lose money. SPAC managers can accumulate substantial wealth even if shareholders don't see gains, depending on the terms of the deal. Now, with that said, the average performance of IPO is not too hot either, since IPOs tend to underperform the market in their first year according to research covering the past 3 decades. IPOs tend to take place when it's a good time for the company or for its insiders to sell. This also may be a good time for the public to buy, but these are rare coincidences. The cheap money era also makes investing in IPOs riskier than ever before. If we look back at some of 2019's big IPOs, they turned out to be major flops. Uber drops almost 35% in the first 2 months, with further drop in October when insiders were allowed to sell their shares. Lyft dropped almost 50% in the first 6 months of trading, and Smile Direct Club 37% in the first 3 months. Of course, there are exceptions, and we have seen a few successful IPOs like Zoom and Pinterest, or SPACs with DraftKings, for example. But it is important to understand the role that interest rates play in valuating a company. One of the valuation methods is the discounted cash flow model. This basically takes the present value of companies' future cash flows. So let's assume company A is earning $100 for the next 3 years. If interest rates are at 10%, the present value for the cash flow in year 1 is $91. This is how much money you would need today, which invested at 10% for 1 year would give you $100. By the same logic, the present value for year 2 is $83.75 for year 3. The present value of the cash flow is $249. If interest rates were 0%, then you would need $100 to have $100 in a year from now, 2 years and 3 years at 0% interest rate for a total of $300. So when interest rates are 0%, the company is valued higher by 20% in this example. Because interest rates are so low, the valuation of companies is higher. Investors are more likely to overpay for a stock like Uber in hopes of earnings growth, and they are willing to wait around for the stock to soar. If interest rates were 7.5% like in the 90s, most investors would just invest in bonds unless the valuation of some of these IPOs would be much lower. In conclusion, if you are excited about a new issue, be it a SPAC or an IPO, the main ingredient for a successful investment is patience. The top startup like Microsoft, Alphabet, Netflix, Amazon, and so on offered many years of opportunities, and they have many years of growth ahead. If you like an IPO, you can always wait until the new issue frenzy dies down. Maybe even wait until the insider lockup period ends, which is the date of which insiders can sell their shares after the IPO. See how it looks, and then if you still like the business, you can invest and it could turn out to be the great buy you've been looking for. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.